If you ask any professional investor what they're looking at right now, they're probably gonna say oil. And why wouldn't they? It tends to move in times like these. But what they really should be looking at is yields. Treasury yield slipped after a very weak bond auction, which saw dealers pick up to $70 billion worth of bonds. Stocks across the board actually lost, but technology stocks prevailed. So what exactly does this mean for interest rates, and should we be concerned about the resurgence in yields? Today, we're going to discuss that and the health of the economy. We're also going to be talking about the risk in small caps and why this chart will tell you the future momentum of equities. Will we go higher, or is this the end for new all-time highs? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. Quite a red day here for the shortened trading week. Very red across the board, and the selling was led here by healthcare, industrials, as well as financials. Very red across the board, except for PayPal. Got some news on its ad sales business. It was up in financials. We also saw that semiconductors bucked the overall trend of selling here today, led by Nvidia. But it wasn't just Nvidia, it was actually broad-based. Look at AMD, Qualcomm, Intel, Micron. A lot of these stocks actually hit an all-time highs as well. And technology did actually participate as well. Amazon was in the green, so too was Google, Meta. And then Apple and Microsoft were flat. However, Apple was actually up early on the day, plus 2% on news that iPhone shipments was up 54% to China. But actually see it pretty flat on the day meant there was some hectic selling from the highs into the close. Energy was also really green today, and this had to do with some Fed speak. Kashkari said some hawkish things. And that just made investors nervous with regards to inflation, and that's why inflation hedges did really well. You can't really see it good on this chart, but inflation hedges, metals, copper, gold miners also did really well today. And then we did see a little bit of a utility trade again, sort of like a proxy to energy, but utilities were also pretty red on the day. But one of the better sectors in the context of the broader market. And then we actually have a look at sectors individually. So we had the metal sector as well as GDX. GDX is a proxy of this metal sector. It's actually just a subsector of it. You know, they were the best performing sectors here today, along with semiconductors and energy. So it was really like the technology trade, semiconductor trade, XLK, semis, and then inflation hedges, you know, XLE, XME, GDX. They were really the top performing sectors. Then we also had XLC right here. Again, XLC, you know, the technology trade, it's Meta, Google, Netflix, Disney. And this did help the SPY return positive for the day, up 0.07%. We also saw utilities, the next best sector below the SPY, down 0.1%. But then every other sector was actually down, with stuff like industrials, home construction, healthcare, and financials all down greater than 1%. A very rough day here for the market. But it wasn't just Kashkari who came out and caused the market to react very poorly. Intraday around 12:30 and around 1:30, we actually had two bond auctions. It was a really terrible bond auction. And you could see that a lot of sectors were actually positive heading into 12:30. And then after 1:30, a lot of them were actually negative, powering a lot of the early gains they found in the early morning trade, simply because those bond auctions were absolutely terrible. And that did spike yields. Coupled with hawkish Fed speak, you're going to have stocks that sell off into the afternoon. But the sectors that pulled the most weight, like technology, like semiconductors, like XLC, did gain today. And that did help the overall momentum of the S&P 500. But let's hop on the charts. Now, looking at the charts, we're going to start our day off by looking at market breadth. So this is percentage of stocks above the 20-day moving average and the 50-day moving average. And we can actually see breadth continues to deteriorate while the S&P 500, the broader market, continues to move sideways. And in fact, if you look at something like the Nasdaq, it continues to actually move up. That is a new all-time closing high in the Nasdaq 100. And we can see only 42% of stocks above the 50-day moving average, 34% above the 20-day moving average. So short-term and medium-term breadth indicators not looking that great while the market continues to trend sideways. And that just goes to show, again, a small amount of stocks keeping this entire market up. And that has to just do with technology, semiconductors, and then certain parts in the commodity index. And looking at concentrated stocks, the Nasdaq 100 was actually up 0.32%. Again, you know why, we spoke about it on the market heat map, but the IWM was only down 0.14% right here. The Dow Jones lost a lot, same with the RSP, mostly because of healthcare, financial stocks. You know, there's a lot of names in those sectors, and when they're down, you know, the Dow Jones and the equal weight is going to be down for the most part. Mid caps too, and the SP 600 was down 0.65, 0.36%. Growth completely outperformed value, but value is actually up quite a bit here in the after hours. Very, very interesting. Now, yields did rise significantly on the back of the Fed's bond auction. We saw some very key levels. The 4.5 level we broke above, and that probably means we can actually see higher price action here in yields, but we have to see if this is just a fake out or if we are going to pull back and use this as a resistance zone for yields to move higher. We do know that the Treasury has a lot of supportive actions with regards to bond buyback and tapering. This could be like one final shakeout before yields continue their move lower, but we'll see what happens for the rest of the week. As a result of that, it was a brutal day for the bond market, but not so much gold. While the US market was closed, gold actually rallied quite significantly, and that did help the overall sentiment and price action in gold miners. You can see gold was up 0.21, 0.73%, and 0.41% here today. And if you look at this price action from a technical aspect, it does look like gold actually wants to go make new highs. You can see that we're forming lower highs, and we put in another lower high right here, especially with the fact that we hit an all-time high right here and then another all-time high right here. It probably means that if we go ahead, hit another all-time high, that's just a trend continuation, and then we could pull back, form another higher low, and we could just see gold continue its price action upward on a technical basis. We actually saw silver hit a new all-time closing high here today. Very, very bullish momentum and very similar to gold, although it just looks stronger on a year-to-date technical chart. And again, silver has a lot of room to pull back to, it form another higher low, and then, go ahead and hit new all-time highs to continue the run. Now, we also saw crude was up 2.71%. That's why energy stocks were really up big today. But there's no reason to get worried. We did say $76 to $87 is the range that crude is probably going to trade in for the rest of the year. So if crude actually continues all the way up to like $87, $86, $85 a barrel, that could be something. But do take into consideration that Biden is actually selling quite a bit of SPR, and that is going to have downward price action into crude. And we also have the OPEC meeting in about 3 or 4 weeks, close to 2 weeks now actually. But let's actually look at the S&P 500. So firstly, the S&P 500 continues to trade sideways, and the RSI continues to work off some of these overbought conditions we saw here at the top, which is a very good thing. But the broader market is where there's a bit of weakness. Looking at the RSP, we can actually see that the level we're looking at is the 163 level this week. And we did see a bit of buying action come in here, but I do think that we're going to find support at this level, and then we're going to move from there depending on the data. We get the GDP data or the PCE data. That's really going to determine what's going to happen for the rest of the week. Earnings is pretty much done. So I think the market is really just like trading, heading into these key prints. I think, PCE is the Fed's preferred gauge of inflation, and the market does pay more attention to that than it does CPI, as well as these GDP numbers. But looking at the S&P 500, I would say that, if you are bullish and if you do think the data is going to come in cool with 52.50 as a very, very key support zone. If we do pull back to this area, you want to buy here and look for all-time highs back to 53.50, back to 5,300, and as high as 5,400, where the core resistance is currently positioned. If you are a bear, you also want to look at this level right here. And if the data comes in hotter than expected, then you do want to look to probably sell any dips into this area. But if you are a bear, you probably do want to get out at this 5,200 area, and maybe as low as maybe 51.75, 51.50, because there's a lot of option support in this area right here. And really, we are in an uptrend, so you don't want to overextend yourself as a bear. Now, I am bullish. I do think the data is going to come in cool. Both and Goldman do think the data is going to come in cool. So if we do actually pull back into the early morning trade here tomorrow, into this 52.58 area, look to buy those dips and then look to higher price action. If not, I think, we are probably going to trade sideways until we actually get this data, and then we're probably going to move higher into the rest of the week. But what we really do want to see is broader market participation. The RSP looks a bit weak. The Dow Jones is also looking really, really weak. The IWM, not quite as weak as the rest of the market, but we can actually see in after hours down 0.21% when the RSP is actually up. So that's a bit concerning right there. But we do want to see broad market participation. That's once we can get that broad market participation, once we can get more than 50% of stocks back above their 20-day, back above their 50-day, we should see upside continuation in the market. But it looks like, market participants, investors, traders are just buying time ahead of these key inflation prints. And once we get those out of the way, market should open up to further upside. Now, guys, the weekend poll has wrapped up. The question we ask is next week for the S&P 500, are you bullish, bearish, or neutral? And there were 934 of you casting your votes. 51% of you are bullish, 36% of you guys are bearish into this week, 13% of you are neutral, so overwhelmingly bullish. And just for context, last week the number was 55% and the S&P 500 finished flat, the Nasdaq finished up, the RSP, Dow Jones, small caps and mid caps all actually finished down greater than 1% for the week. So had you faded the weekend poll, and if you were in the right indices like the IWM, like the SP 600, you would have done very, very well. But that was last week. What about this week? Well, 51% of you are bullish, and I do think if economic data comes in line, maybe even slightly cool, we do know that both of the things the data is going to come in cool, at least on the PCE front. We could definitely see some bullish momentum that's going to affect yields, and we're going to see further upside here in markets. That being said, there's a reason why 51% of you guys are also bullish, and it has to do with seasonality. The S&P 500 finished the first 100 trading days of the year up 11.5%, and normally when the S&P 500 is up 10% or more over the first 100 days of the year, the rest of the year is up 76% of the time, average return 7.1%, and the stats are on the side of the bulls, so we can actually expect more upside. Furthermore, adding on to seasonality, looking at the 3-month seasonality for all years back to 1928, so a huge pool of data. This is where we are right now, May to July. We can see that we are in a very, very bullish period here, pretty much from May to July, June to August, July to September. We can see average returns of 2.27%, 3.2%, and then 1.28%, with extremely high hit rates as well, all above 50%. That's exactly what you want to see. The only negative 3-month period is here in August to October, down 0.14%. And again, it is positive 54.2% of the time. If we are really going to look for some downside, it's probably going to be anywhere from August to October. We can definitely see that the July to September period can be positive. So we're probably looking towards more the end of this period being negative into this October period. This will just be a dip buying opportunity because we can expect September to November, October to December, and then November to January to be exceptionally positive, up 0.43%, then 2.9%, 3.54%, and 2.48%. And this actually is the 3 most bullish periods across the entire data set. So there's plenty of reasons to be bullish because we do have tailwinds right here. And the only time we can actually experience downside volatility is only after July. So we can expect higher price action through May, through June, into July, and then we could start looking at maybe a pullback later on in the year. Now, the technicals are on the side of the bulls, but also the fundamentals. You can see here that Magnificent 7 earnings estimates have been actually revised up year to date, while the 493 were cut. Now, this makes it look as if the 493 are actually producing negative earnings, but that is simply not the case. First quarter earnings came in positive at 0.9%. Market expectation at the start of earnings season was actually negative 2.1%. Then we are actually expected to see the other 493 return 7% in the second quarter, 7% in the third quarter, and then double-digit growth 13.2% in the fourth quarter of 2024. At the same time, the Magnificent 7 are producing double-digit growth, mid to high teens at minimum across the second, third, and fourth quarter. So when the broader market participates in earnings and we have favorable technicals, markets tend to rally, and that's actually what we've seen throughout May and throughout 2024. And as earnings increase, so too does shareholder value. You can see here that in recent quarters, companies have issued a record amount of cash dividends, bought back a record number of share repurchases, net payouts close to all-time highs, and companies have actually been reducing debt for quite a number of quarters. In fact, the last 10 quarters, companies have actually been reducing debt, increasing their cash on their balance sheet. And that is part of the reason why S&P 500 companies have remained so resilient in the face of higher rates. In fact, based on this right here, S&P 500 companies have actually gotten stronger in the face of a tougher macro environment. But not all companies are made equal. Small caps have actually suffered, and it seems like the pain is expected to continue. Small caps have a relatively bigger share of debt coming due in the next 5 years. This is 2024, so S&P 500 companies have more debt due, but we do know that they've actually been reducing their net debt to shore up their balance sheet. And then the same is true for 2025. And then we have Russell 2000 companies have very close to 20% of their debt coming due in 2026, about 18% of their debt coming due in 27, about 19% of their debt coming due in 2028, and then just under 15% here in 2029. It's going to be really interesting to see how small cap companies navigate this period, particularly after 2024 into 2025-26. Because if these companies can't refinance their debt, there's only one way this all ends, and that's through Chapter 11. However, we do know that small cap earnings as well as mid caps are expected to be exceptional from the second quarter 2024 all the way through 2025. We can see here that CY24 earnings for the Russell 2000 index is expected to come in at 18.43%, and then at the end of 2025, 32.65%. So hopefully these can be inflection years for exceptional earnings growth into 2026, 27, 28, which will allow these companies to refinance and pay down the debt that's coming due in these years and beyond. Now, the Atlanta Fed's GDP now is sitting at 3.5%. We've had a slight acceleration here. I think this was probably after the durable goods print, but for Q2 2024, the expectation here for GDP is sitting at about 3.5%. And we have started to see GDP decelerate in recent quarters, but that's not necessarily a bad thing. GDP and EPS rarely diverge, but a slowing GDP and accelerating EPS has historically been the best backdrop for equities. And this is because of two reasons. Slowing GDP often leads to moderate economic growth, which can help control inflation and avoid an overheating economy. This is often a positive for businesses and equities. And secondly, companies actually become more efficient and profitable as GDP decelerates, possibly due to cost-cutting measures, better management, and new innovations. Accelerating EPS indicates that companies are improving their profitability despite overall economic growth. And based on this chart right here, when EPS is accelerating and GDP is decelerating, the average quarter-over-quarter return for the S&P 500 is 3.6% with a hit rate of 79%. So even though GDP is decelerating, that's not necessarily a bad thing. As long as EPS is improving, what's actually happening to the overall market is that companies are finding operating leverage. And sometimes I feel like a robot when I say this, but in times when earnings are growing and margins are expanding, companies are finding operating leverage. You want to hold equities because the path of least resistance is up. But let's actually dive into other parts about the economy. We're going to talk a bit about the labor market, probably one of the three pillars of the economy that you need for a healthy economy. A strong labor market normally precedes a strong economy, and we can actually see here that the labor market is holding in there. We've seen strong labor market growth here in January, February, March. It's part of the reason why we actually did get that sell-off here in April. Just people worry that the economy might be getting a bit too hot. But we can actually see here that April's print came in a lot cooler than March prints despite 3 months of acceleration. And the May print is expected to come in cooler than that. And we are expected to see decelerated labor market jobs growth up until about the 150,000 mark, where we should see it balance out through the rest of 2024. This is well above the current short run rate. This is the minimum jobs required for the economy to function in a sustainable way, and we are well above that figure. And this is very, very healthy, robust job growth. And if this continues the way we expect it to, it should cap wage inflation, but also contribute materially to GDP overall. At the same time, we got some data here from Goldman Sachs. They say the overall probability of finding a full-time job also remains at or above pre-pandemic rates, suggesting that workers continue to transition from unemployment into employment without the need to settle for part-time jobs. So with the economy remaining strong, those that do find themselves without work generally do find themselves back into full-time work without needing to settle for part-time positions. And we can see this with the full-time job finding probability. At the same time, declines in gross hiring rates have been correlated with declines in quits rates, but not with increases in layoffs, suggesting that the decline reflects a reduced need to replace workers who quit rather than weak labor demand. So all in all, the labor market continues to remain fairly robust, fairly healthy, and we do expect the labor market to continue to remain healthy. And as long as people have jobs, consumption will continue. And if consumption doesn't deteriorate, the economy will keep chugging forward, and it's just business as usual. So looking at Gamma, exactly what I thought was going to happen on Friday actually happened this week. Very, very interesting, the changes that have occurred. We saw a lot of negative Gamma roll off the tape. I did say that would happen on Friday's video because we saw a lot of elevated levels of negative gamma. We also see two glaring things, and that has to do with the call resistance. It's here at 5400, but look at the 5500 strike right here, getting built out quite significantly, and even this 5600 strike. So traders are really moving up the tape. Now 5400 still is the biggest, and the biggest by a wide margin, and the gamma flip zone is still 52.95. So as long as we're above this 5300 area, we're buying dips, we're selling rips all the way to the 5400 area, and we're potentially eyeing 5500 into this June OPEX. Very, very bullish, but let's not get too ahead of ourselves. Buy dips, sell rips to 5400, but the gamma flip zone is right here at 52.95. Some of these strikes are building out, the 5200 strike, the 5100 strike. We actually did see the put support move up to the 5,000 level here from 49.50. So don't discount the fact that we can move into negative gamma, especially if we get some bad data on our side, especially if data doesn't come in the way we want to. But if we are in positive gamma, the path of least resistance will be to 5400. Now, with regards to data this week, the two big ones are coming on the 30th and the 31st. We have GDP as well as PCE. Now, for GDP, we're expecting a 1.2% print here, personal consumption quarter over quarter 2%, then the price index at 3.1%, and then core PCE quarter over quarter seasonally adjusted at 3.7%. And then we'll tackle our expectations for PCE in tomorrow's video. Now, this week we have two major macro data releases, and normally that doesn't bode well for the S&P 500. You can see here that no news is actually good news, and when there's zero major macro data events, we actually can see returns of 0.62%, and you can see a one key macro data release, 2 and 3. We have 2 this week, and normally the returns for the S&P 500 tend to be the worst at about 0.2%. So do expect volatility, and if we do get sideways trade for the rest of the week, don't be surprised. History tells us that's what normally happens in weeks like these. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, like this video, and leave a comment for the algorithm. Cheers.